As a house flipper, you need to quickly be able to give somebody an offer price. And it sucks to do the math every time. And that's why I built this calculator. You can have it for free. And here's how you use it. I call it the flipping calculator. All right. Basically, here's what it does. You find out the after repair value of the house, what you think it's going to sell for. You put in that number. You put in the rehab cost, $60,000. Boom. It spits out what your offer price should be, $190,040. Note that we also built a calculator for the rehab costs. That's a different video. We'll link it here at the end. But how do we get those numbers? You click down on the advanced section here, and you're going to be able to change some of these numbers so you can influence your price. These are the default settings. These are the ones that I use when I use this to actually make offers on houses. It's also going to give you a little bit more information, the total cash that you're going to need to close and rehab this deal, get it to the finish line. It's going to tell you the profit that you're going to put in your pocket after the deal's done. And it's also going to give you your annualized return. As a house flipper, you want to always be targeting 15 to 20% profit on the money that you put in the deal. So if I put $283,000, and when I say put that money in, that might mean you borrowed that amount of money. That's how much money you're going to need from start to finish. But I want to make 15 to 20% on the money that I have in the deal, whether it's my money or somebody else's. You see how changing the rate of return, the profit that I make, changes the acquisition price. If I want to make 20%, I need to get that deal for $179,000. If I want to make 15%, $190,000. That is the number you're going to tweak on your offer price. So you might have an initial offer of 20%. Obviously, when I'm making an offer, I'm not showing people that part of it. This is what they're seeing. So those are the two main levers, right? My rehab price and my rate of return. Most of you are going to get loans to cover the cash. So you have your interest rate of 12%. That's standard for a hard money loan. And points up front might be 3 or 4 points. That's going to affect your total offer price. Now, I hear some of you out there saying that, well, I have cash, so I don't have any interest. Well, of course, you could change this to 0 and 0, but you notice how that is upping your acquisition price. All right. So what I suggest that you do, all right, so you could, one method might be that you're bringing your own cash so you can offer more for these houses, therefore beating out your competitors who are trying to get the houses for cheaper. Or you can treat your cash as if you're a lender and you're paying yourself the 12% interest, which I believe that you should do because you are technically a hard money lender for yourself. So you can pay yourself that way. And I don't necessarily mean in reality. I mean on paper. That's the way that I like to look at things. Okay, so based on your interest, your hold time, obviously, if you're holding it for a whole year, you're paying a full 12%. If you're holding it for 6 months, you're only going to have to pay half of that because you're only holding it for half of the year. You get it. Other costs, 2%. This is just the way that I figure in closing costs, utilities, insurance that I'm going to have to pay for as I'm holding the property. I just figure it at 2% is my default. And then when I go to sell the property, I'm going to have to pay around 7% is the default. Those are your real estate commissions and closing costs on the back end. So basically the formula works out to total costs, which is acquisition price plus rehab plus interest on the loan, points on the loan, plus other costs. Okay, all of that plus my rate of return, the profit that I actually want to receive, equals the after repair value of the house minus the cost to actually sell the house. That is the equation in a nutshell. Obviously, a lot more goes into it than just working that out on paper because you have to backwards figure out your acquisition price. All that's built into the calculator. So you simply just put in your after repair value and you'll know exactly what you should purchase that house for. And one other little feature here is that you can email yourself that report. Cool if you want to keep it in your inbox for all the offers that you give out. One other quick thing for you guys. This is called the flipping calculator, but it also works for rentals. And I know a lot of people have trouble wrapping their head around how flippers hold houses as rentals. And it is basically the same thing as selling it. You have two options when you get to the end of a project. You're either selling it to the market, actually flipping the house, selling it to somebody who's going to come live in it, or you can, as I call it, sell it to the bank, meaning you go get a loan from the bank on the house. Okay, here's how it works out. If my rate of return is 20, okay, that means that I needed $271,250 total cash needed, whether I borrowed that cash or I put it in myself. That's how much money I needed to do this deal. I bought it for $174,000 and the after repair value is $350,000. Now you're going to go to a bank and say, hey, I have placed a tenant in this property and I would like to do a refinance. And what they do is they take the value of the house, they send an appraiser out to figure out how much it's worth, and they come back and they say it's worth $350,000. And a bank on a stabilized property, stabilized meaning there's a renter in it already, they're going to give you 80% of the value of the house, LTV, loan to value of that house, as a loan that you can pay over 30 years, a 30-year mortgage. So what's 80% of the 350? That is this exact number. That means that the bank is either going to take out the loan that you already had, the hard money loan at closing, they pay off the hard money loan, and then you have their 30-year mortgage in that place, or you're going to do what's called a cash out refinance because you bought the house in cash, you financed it yourself, so the bank who's giving you this 30-year mortgage is going to pay you that money. Now, note that on a cash out refinance, they're going to give you worse terms, meaning higher interest rates, and they may not give you an 80% cash out. They may do 70 or 75%, which might answer the question for you. Why do flippers who are rich already take other people's money? Well, it's because if I borrowed the money to buy this house, instead of doing a cash out refinance, I can do a rate and term refinance, which I get better interest rates and an 80% LTV on the appraisal. And that's how every flip and every rental are exactly the same. And as I mentioned before, I also built an app to be able to quickly figure out your rehab costs that you can plug into this calculator. Did a whole video on that as well so you can know how to use it. Once again, it's free, just like all my stuff. Thanks, guys. Talk to you soon.